Hello traders, join us in this video as we elaborate an intermarket analysis perspective on commodity forex correlations and also the significance for forex market participants. We begin by mentioning that intermarket analysis is a method that examines the relationship between different financial markets, which we will utilize to reveal significant insights into how commodities and currencies interact. We also have to note that it is important for forex traders to note that the relationship between commodities and currencies is a complex one and driven by various factors including economic conditions, geopolitical events, and market sentiment, among others. Commodities such as gold, oil, and other natural resources play a vital role in influencing currency prices. As a matter of fact, countries that are major exporters of commodities often see their currencies closely tied to price movements of these commodities. For instance, Canada, which is a leading oil exporter, has its currency, that is the Canadian dollar, highly correlated with oil prices. As such, when oil prices rise, the Canadian dollar tends to appreciate, which is because higher oil revenues improve the country's trade balance and as well as its economic outlook. Conversely, when oil prices fall, the Canadian dollar often depreciates due to reduced export revenues and economic concerns. Similarly, Australia, a significant exporter of gold and other minerals, experiences a strong correlation between its currency, that is the Australian dollar, and commodity prices. Typically, a surge in gold prices leads to an appreciation of the Australian dollar as higher export earnings boost the economy. On the other hand, a decline in gold prices can weaken the Australian dollar due to lower export income and potential economic slowdowns. The relationship between commodities and currencies is also influenced by the economic health of major importers. For instance, Japan is a major importer of oil. As such, fluctuations in oil prices can impact the Japanese yen. Rising oil prices can lead to a depreciation of the yen as high import costs strain the economy. Conversely, falling oil prices can strengthen the yen by reducing import costs and improving the trade balance. Forex traders can use such correlations, or traders should use these correlations to their advantage by monitoring commodity price movements and understanding their potential impact on the currencies that are related. For example, a trader observing sustained increase in oil prices might anticipate an appreciation of the Canadian dollar, which would inform their trading decisions so that they go long on the Canadian dollar against other currencies. Conversely, if a trader sees a significant drop in gold prices, they might expect the Australian dollar to weaken or to fall and short the Australian dollar against the US dollar against the US dollar among other currencies. Additionally, Forex traders can look at the broader economic indicators that influence commodity prices. Factors such as global economic growth, inflation rate, and geopolitical events often drive commodity price movement and, as a result, the currency or the related currencies. For instance, a strong global economic growth tends to increase demand for commodities, pushing up prices and benefiting commodity exporting countries' currencies. Conversely, economic slowdowns can reduce demand for commodities, leading to lower prices and weaker currencies for these nations or weaker currencies for the related countries. It is important to note that geopolitical events such as conflict in major oil-producing regions or trade disputes can also significantly impact commodity prices and related currencies. Forex traders need to stay informed about such events and assess their potential effects or potential impacts on the markets. For example, tensions in the Middle East can lead to fears of oil supply disruptions, driving up oil prices and potentially strengthening the Canadian dollar. Conversely, a resolution of trade disputes might boost global economic confidence, increasing demand for commodities and supporting the currencies of the exporting nations. Furthermore, forex traders should consider the role of central bank policies in shaping commodity-currency relationships. Central banks in commodity exporting countries might adjust interest rates and monetary policies in response to changes in commodity prices. For instance, a central bank might raise interest rates to counter inflationary pressures from rising commodity prices, which can attract foreign investment and strengthen the currency. On the other hand, in response to falling commodity prices, a central bank might lower interest rates to stimulate economic growth, potentially weakening the currency. By integrating intermarket analysis into their trading strategies, Forex traders can develop a more comprehensive view of the market dynamics. This approach is significant in helping predict currency trends, risk management, and, more importantly, maximizing a trader's profitability. Simply put, traders can use commodity price trends as leading indicators for currency markets. We'd like to conclude on the following highlight. The relationship between commodities and currencies is a fundamental aspect of intermarket analysis that Forex traders can exploit for profitable trading opportunities. Thank you for watching. Let us interact again in our next trading video.